Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. In this episode, we speak to portfolio manager Darren Lekkerkerker to get an update on the North American Equity Plus Fund, his thoughts on the current market environment, and what industries are market drivers in his mind. Darren says the economy continues to be resilient even though rates have not come down as expected earlier this year. Company earnings have accelerated, and we've seen differentiation between sectors and within sectors. Darren says this environment has been good for him because he is primarily a stock picker, where he focuses more on the micro side rather than the macro environment factors. In terms of his investment style and stock picking strategy, Darren continues to look for high-quality companies that have a competitive advantage, that are growing over time, and have demonstrated superior return on invested capital, ideally rising over time. Darren adds that technology and AI are big market drivers. He owns software, Constellation Software, Microsoft, and Nvidia. He's also invested in the industrial sectors, including engineering and design companies. He believes they will benefit from massive fiscal infrastructure acts in the US. Darren points out he doesn't hold any Canadian banks in his fund. At the moment, he is nervous about the Canadian economy compared to the US. He is concerned about the Canadian consumer, since they are more interest rate sensitive than their US counterparts, and because of our mortgage market structure in Canada. This podcast was recorded on June 12th, 2024.
Nice to see you again.
Hey, Pamela, I'm happy to be here.
Delighted to see you, Darren. Great to have you join us. We'll have everyone send their questions in over the next half hour or so for you to answer a little bit. Let's talk a little bit about just framing up what the inflation story has meant for you and investing, the rate story. We're on the edge of it here.
Yeah, sure. So happy to see inflation data come in a little softer this morning. The market is taking that well as global markets are up as we are recording this right now at 11 a.m. So I think for me overall on the macro, look, I think stocks are expensive versus history. But having said that, and I think also inflation's been a little stickier, so it's nicer to see it come in a little softer. And I think rates are haven't come down as much as people would have thought at the beginning of the year, but it's nice to see them coming down a little bit this morning. Yeah. And so I think going forward, I think, look, the economy has been resilient, especially in the context of everyone calling that we are going to have imminently or already in a recession since 2022. So it's been fairly resilient, and I think so have company earnings. I think company earnings have accelerated this year. But importantly, there's been a lot of differentiation between sectors and within sectors, which is great for people like me who focus more on the micro than the macro and on picking stocks.
I remember you've always said too that there is always bad news. You could always sort of focus on the bad news, but there's also often market growth happening underneath it all, and that seems to be the case over the last little while. In terms of dispersions, it's been a year where we talk about stock picking specifically. I'm sure it's always that. Your particular style is sort of what we call quality in a lot of ways. I mean, that's what has been working beautifully, actually, over the last little while. What do we go into your process a little bit and describe a bit what seems to be working so well?
Sure, I'd love to do that. So in terms of my style, I'd say that I'm really looking for high quality compounders or high quality companies that can compound their free cash flow per share. And so what's a high quality business? I think it's a business that we can understand. It has a competitive advantage that's actually growing over time, and that they're able to have a superior return on invested capital that's ideally rising over time. I'm always on the lookout for monopoly type of businesses or any kind of like undercover sort of monopoly businesses. I've owned railways big in the past, which have been monopoly businesses. Constellation Software is in my top 10 today, which is in vertical market software, which is a bunch of different miniature monopolies, which tends to do very well. I focus a lot on management. Are they economically aligned with us as shareholders? Do they show a talent for capital allocation, which just means investing reinvesting the free cash flow of the company in high returns? And I also care about the valuation, which I look at free cash flow yield. But importantly, when I talk about compounding, I'm looking at companies that can compound their free cash flow per share, ideally above 15% a year. I think if they can do it above 15% a year for 5 years, then that means that it'll double, and likely if the multiple can hold, the stock should double.
Congrats on all the Lipper Awards. I didn't realize you had so many in a row.
Hey, thanks very much. I appreciate you mentioning that, and
It's obviously been like a great year. Let's go into sort of, we mentioned the drivers that you're seeing right now in the market. And within sort of the tech story, what do you do with that? We all know the names. The question is, how do you invest them? How do you find other opportunities? And so what is kind of the drivers in this whole market right now?
I think for myself, like I tend to focus more on the quality companies, probably more on the more defensive or lower beta companies and the lower, not the highest valuation companies or the sexiest or fastest growing companies. Although I do analyze all the companies and our team certainly does. I've tended to own like software as well as but kind of like the lower beta stuff. I do own Microsoft. I mentioned Constellation Software, which is a software consolidator. So I think the organic growth for that business typically tends to be low, but they've been able to grow very quickly through capital allocation, through buying other vertical market software businesses. They've been able to grow at a very fast rate despite having little to no leverage. I really admire the company. We've been lucky enough to be close to the CEO and management over time. I really like that they have a rule where they require executives to reinvest or invest 75% or something like that of their bonus in the market into the stock of the company. I think that promotes great alignment as well. I'm interested in the internet sector where I think that we're seeing really nice growth. But one of the detractors also is the increase in CapEx. And OpEx, and I think AI, while has been a driver of stocks, has also been something that requires a huge amount of investment. And I think that there's a feeling that this will be a winner-take-most world. And so I think that the companies are accelerating. Certainly, Nvidia has been a huge beneficiary of that trend.
Do you own Nvidia?
I do own Nvidia.
So we have to ask that because it's a big question for lots of different funds. That said, I mean, so I think you've spoken to some of the tech dispersion, what you like within it, but there is tech dispersion. I mean, we've seen the Nasdaq go crazy in recent days. Like these are other stocks doing well also, but there's also just talk about the tech dispersion that you see if you like it
within tech. So I think one thing is, first off, is like last year you had this world where it was really tech driven and really within tech driven by the Magnificent Seven. And if you look at that, like AI became a huge theme last year, but also you saw massive earnings growth in the sector. Part of it also was you went through a period of COVID where they added tremendous amounts of headcounts and other infrastructure, and then they started to try to have operating expense discipline. So you saw margins, while revenue reaccelerated, you saw margins really inflect positively. So I think this year, I think you're still seeing nice earnings growth there, but I think you're seeing it from the broader market as well. So I think that's why you're seeing some of the areas in the market do better. I think certainly within tech, some of the losers have been hit either because of greater spending on OpEx and CapEx, surprising and disappointing the market. I think also
the software story.
Generally, sure, of course, software. I think part of what's going on there is you have this fear by the market that because of AI being such a huge theme that CTOs are spending their money there and taking it away from other areas like enterprise software.
It's fascinating to watch this whole AI theme work its way through so many different areas of markets. Let's talk about engineering is actually an area that you spoke about a while ago. You liked it. There are lots of infrastructure spending. When we speak to Yurin, he's talking about the fiscal dominance story. There is spending on infrastructure going on. Tell us a little bit about how the engineering firms like about them.
So I own a lot of stocks in industrials, and one of the reasons is there's a lot of growth in business to business, and there was these massive fiscal spending acts. So in the U.S., you have the CHIPS Act, the Infrastructure Act, the IRA Act, and so these companies are going to benefit. The engineering and design companies are prime beneficiaries. They have pretty nice organic growth rates. I think even globally, you're seeing countries, while they may not have these big fiscal spending bills, they're still spending there. I think there's also other huge trends like reshoring going on or massive builds of data centers that some of them could benefit from. I think the other thing is there's an increase in margins that's happening there, and there's a nice avenue for them to redeploy the capital into buying sort of smaller engineering and design firms. And I think we've done a lot of due diligence here, and we've picked our favorites for companies where they're able to transform their portfolio and improve their growth. And we think we can spot some nice winners there.
So speaking of mergers and acquisitions and smaller companies getting bought up, let's talk about financials for a second, because there was a blowout announcement in that landscape in Canada. Well, you know what it is, but what do you think of the financials in Canada, first of all, and then we'll get to that.
Yeah, so I'm not that enthusiastic overall about Canadian financials. In the Fidelity North American equity class funds, I don't own any Canadian banks, so I'm not as enthusiastic. And so, like, why is that? So I would say that I'm a little more nervous about the Canadian economy than the US economy, which I would prefer. The Canadian economy, I'm a little more worried about the consumer here, although, I'm still looking at the US consumer as well. But with Canadian consumer tends to be more interest rate sensitive because of the structure of our mortgage market. And so that makes me a little bit nervous there. And I also just think that the Canadian banks aren't particularly cheap for being in a sort of softer macro or softer fundamental earnings market.
So what did you think of that merger?
Yeah, so that
Just kind of been wondering if we're going to see the next one from the Canadian bank.
Yeah, and it had been, I've heard that rumor for like many, many, many years. But yeah, so they announced it after the market that National Bank is buying Canadian Western Bank, and then they had a public call, and then we had our call with management.
When you say we, you mean like
us at Fidelity. And
so
the Fidelity portfolio managers, and it was run by our Fidelity Canadian banks analyst. And so, yeah, I've had some time to think and to think on this and hear from our both management team of National their thoughts on and their investment thesis on the deal. Look, I think for me, I think the deal makes sense. I understand the rationale here. Like, you've got one bank in the East, one bank in the West. They're in different product groups, so it makes sense. But I do think that, look, they're paying over 100% premium to buy that, so it's not particularly cheap. It could take a year and a half for this to close, and then it could take 3 years to realize the synergy. So
could be a while.
It is a little while out, and so I think you have some time there. Just given that I don't love Canadian banks at the moment.
When you're looking around at either mergers, acquisitions, or just the landscape, there's been a discussion that PE firms are less involved because rates are higher. Is that kind of an interesting time to invest actually and to look around at companies just because certain players aren't involved in that area?
Yeah, I mean, I don't think you're absolutely right. So I think what we're seeing on traditional private equity and also I think a little bit on venture capital is we're seeing new fundraising not being as robust as it was in the past. We're also not seeing as many exits of deals because the IPO market is I wouldn't characterize it as hot. No. And so I think that you're not seeing as much liquidity there. I don't think this is an investment thesis in and of itself, but for the companies that I do own that are competing with private equity to buy companies, to deploy capital, for example, I mentioned software consolidation. I also own other companies in my portfolio where this is a potential benefit. I think that's a nice positive or a little bit of a tailwind. So
yeah, it's sort of a nice to have
right
there. Really interesting. So that's financials, engineering. Are you involved in utilities at this point?
No, I'm not. Has been a hot area, not in Canada, but a little bit in Canada, but more so in the U.S. market. Just more so as we've looked at first AI, you looked at the first and the second and the third derivatives, that these data centers require a tremendous amount of power. And so I think for those utilities that have uncontracted power, especially if it's nuclear and can be contracted, I think you've seen those stocks do really well. It's not something I've benefited from. Like, one thing that I should say is that, like, I tend to focus on, because of the high quality focus on it draws me to certain sectors. And so I like tech. I'm not that big on consumer right now because I worry a little bit about the health of the consumer. I don't think it's as bad as people say, but I'm a little worried about it. But I think generally it's a big sector with a ton of growth. I look at industrials, and then it also allows me not to look at certain sectors. So I think utilities, pipeline, REITs, they're capital intensive. The utilities are regulated. They're interest rate sensitive. They don't tend to grow that fast or compound their free cash flow as much. And I kind of talked about how that's part of my process. So I have invested in all these sectors, and I will at certain times. if we do a lot of due diligence, we love a company, we think that it's really cheap. So for example, I owned a mall REIT, I think in 2020 or 2021, just thinking that, hey, this is gonna, I could see the multiple and the cash flow increase as things get better, as we all start going from our houses to shopping, but it's not sectors I tend to own.
So if we go back to consumer, one of the big trends that's connected to many of the other things you just said is this sort of trade down discussion. So it may not be the discretionary consumer story, but probably the more staple side of that. What do you do with that?
Yeah, so I like dollar stores, and it may be surprising to some of our viewers that dollar stores actually have really good margins, and they've, as you've kind of laid out, they've had really nice growth, right? I mean, the consumer has been more sensitive to prices because of inflation, and so I think as a result, dollar stores have benefited. It's an area that I've owned for a very long time in my funds, and I'm continue to be positive on. I think it's more of a stable defensive area as well.
Right, but it's expanding. We're just starting today as well.
That's right.
Yeah, it's a company that's got new areas. So within some of the, as you said, not rails. Is there anything else in terms of subsectors in the industrials that are of interest? The rails story is a bit on just sort of the volumes have slowed down a bit.
Yeah, I mean, I think rails are good businesses over time. They're a monopoly, but I've been more interested in aerospace in the North American Equity Fund. I think aerospace is a great business. There's secular growth. As people start to travel, they like it. They want to travel more. And as more people in the world become wealthier, they want to travel. I think during COVID, you had a setback in manufacturing of sort of new planes, and that increased the backlog. And then Boeing and Airbus have both had recent issues with meeting the delivery schedule, which has kind of set them back more. But I think it just means that you have a really, really nice backlog. And so even if you see airlines pull back a little bit, I met with an aerospace parts CEO yesterday, and he said, if you make an order for a new plane today, you won't get it until 2031. Right. So even if the airlines pull back a little, they would be very reluctant to pull back from their orders. I think you're seeing a nice combination of secular growth and nice margin gains for a few years here. So I've been bullish on the space, and I think there's some of these businesses some parts of their businesses have monopolies on certain parts or on aftermarket service, which has really nice margins and recurring cash flows. Let's
go into the Canada versus US within your fund, what you're leaning more toward. Well, you typically lean more towards, but is it even more so this way? It sounds like the US is where you're more.
Yeah, I mean, I think the US economy looks better, more resilient than Canada. I think that, so right now I think in the North American Equity Fund, the target is 70 US, 30 Canada. Today it's got a lot of flexibility. I can really move that around. It's 75. Approximately 75 US, 25 Canada today. And just for our kind of listeners out there, don't think of this as two separate funds. Think of this as one fund, which is more of a US fund, but owning the best of Canadian winners. That's the goal anyways. Right. It doesn't necessarily have to be, it's not a standalone fund in itself. I mentioned I don't own Canadian banks. I do own some resources today because I really am bullish on copper and uranium, but there's been times where I've owned zero resources, and I would do that in the future. I think resources are cyclical sectors.
For sure.
And so it doesn't always make sense to own them.
So what sort of cycle is this? There's been great discussion about a commodities cycle and what we're supposed to term it and what we do with it and what the drivers are of it. It seems to be different this time. It often is. What sort of commodities cycle would you say we're in?
I think on the copper side is what I'm very bullish on copper, and so I think it's actually very supply driven. So we had a huge mine come off in Panama, which is owned by a Canadian listed company, First Quantum Minerals, and that's very meaningful for global copper supply. I think you're seeing other copper companies have operational issues in other parts of the world where copper production has been disappointing at some large mines. And I think there's also other geopolitical issues. Meanwhile, I think on the demand side, I think the traditional demand driver has been China, which is a little bit soft, but it's stabilizing, or it's recovering a little bit from where it was last year. So that looks incrementally better. And then I think there's a little bit of demand. People got kind of excited. We talked about third derivative AI data center trades. Well, there's a lot of copper in these. And so I think people got a little bit excited. But I think that the math I've seen would be about additive about 1% to global copper demand, which doesn't sound like a lot, but it can be meaningful in the context of like very little supply growth.
You mentioned nuclear before, and this sort of worked into the AI data centers story and actually even to the utilities story itself. As a commodity, the uranium story, is that of interest to you?
Yeah, I'm super interested, right? I think that there is like big demand going forward, and I think nuclear has now become part of the conversation as we try to decarbonize the world, and I think we're dependent on it. And so I think the demand side looks good. And meanwhile, the supply side, I think there's Canada, there's Russia, and there's Kazakhstan, and I think there has been legislation passed to ban, I think, is the highly enriched uranium imports from Russia. So I think Canada is seen as the most reliable global supplier, and so I think that the supply-demand outlook looks very positive. Okay.
Question rolling back to some of your discussions about software in Canada, consolidators themselves. So what are some of the top sort of companies in Canada you want? They mentioned Constellation Software as one that you mentioned, but what are some of the, maybe you don't need to see names necessarily, but like, which areas are you looking at these? Let's go through sort of the sectors again, just to remind people.
Specifically on software consolidators? Yeah, I think so. I think management makes a huge difference here because you need to have management that's very disciplined, that they're buying high quality companies at good prices. And I think Constellation is actually the only one that I own at the moment, which is in the top 10. So I'm able to mention it. And I think that the other thing that I really like about them, I mentioned it earlier, is like they've actually also spun out two companies or divisions recently where they still retain an economic interest, but they've allowed it to spin out because they think it can grow faster, which I think shows like a lot of I'm not sure what the right word is, but I think, but a lot of skill maybe from the management team, because I think most CEOs I think are tempted to like just grow and grow and grow the size of their company, and few of them want to kind of shrink to grow.
Yeah.
So I really like that.
Tell us a little bit about healthcare. Is healthcare quality? Can you say that across the boards?
Yeah, I do think healthcare is quality. I'm trying to find the more defensive, stable growers. One area that I've liked and I'm currently invested in is med tech or medical technology. And
these are devices or
medical device companies. Yeah. And so one of them, Boston Scientific, is in the top 10 for the fund. And that's
the one that's known for like various robots and stuff. No, that's what the other ones.
No, not so much. It's more in. I think they're fairly diverse. They're very big in cardiology, but they're also in other electrophysiology and other areas as well. But why do I like medtech? I think one, there's secular growth here through demographics, through innovation, different product cycles, which tend to bring pricing. I think also there's a bit of a catch up from COVID. There's still very high procedure backlog, volume growth. And I think that there's some catch up from the inflation, post-COVID inflation, where we're still getting above historical trend pricing, which is growing the top line and margins really nicely. And I think there's some new product cycles, which are exciting.
So as we go through whatever comes through the second half of this year, your fund is positioned, as always, to sort of do what in all kinds of markets? What sort of the fund meant to do if there's some choppiness ahead, if there isn't? Give us sort of the sketches of what investors should expect the fund to do in all kinds of markets.
Look, my goal, Pamela, is to own a concentrated portfolio of high quality companies that you can sleep at night owning. So I think that there can be some volatility in the short term. I try to think of that as an advantage when I deploy capital as a manager, but I think that people should be able to sleep at night that they own really good companies that I think will continue to do well in different sort of macro backdrops.
Well, there are lots of different things ahead, certainly in this area. I think. Are there any other questions for Darren? I feel like, is there a certain message you want to leave with people just as they wrap up their conversation here with you?
I'm very well economically aligned with a large part of my savings in this fund. I think three, I really like what I own, and I think we're in okay backdrop here.
Yeah, for equities to carry on.
Right.
Darren Lekkerkerker, thank you for joining us on Fidelity Connects.
Thank you, Pamela.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.